thank you for joining me for a podcast. We're just getting into this with guests, so you get to be one of my first guests. So I'm really excited about this. So should be a good conversation. I'm gonna hit you with a couple different things. I would love to talk to you about what you're doing with alternative investments and how you guys are doing things at Fairway. But I would also love to get your input and your thoughts on the markets in general, the way interest rates are going. But before that, let me lead off by telling, for those of you that don't know who you are, this is Jason Riley. He is the managing partner and he leads the team at Fairway Asset Management. And he has been managing alternative investments, private placements since 2010 as a portfolio manager for an Austin-based RIA. And prior to that, he was involved in different alternatives and in another space. And I'll let you share that story. But you also, prior to your investment career, Jason served as a U.S. naval officer and naval aviator on active duty, and now you're still a reservist. If my memory serves me correctly, you're still in the reserves, and we do appreciate you for that service. But and then you also have an MBA from Macomb's School of Business and a bachelor's in economics, and both of those are from the University of Texas at Austin. So you're not new to this space, and you have a lot of depth of knowledge. But let's lead off by going, what led you into the Navy? How did you first start out? Was this 18 years old and you said free college, or what kind of took you that direction?
Actually, I walked into the ROTC building the second semester of my freshman year with kind of a lack of direction and not really knowing what to do, and then sort of walked out with a uniform on. And a couple of years later, I had 2015 vision, and I'd seen Top Gun as a kid, and they gave me a commission and let me go fly. So it was, I always knew that I wanted to do I wanted to do something more active and engaging, and coming straight out of college, and that was that's what I gravitated to. I've enjoyed the service to the country. That was always a big piece for me, and it's been a defining core part of my life, and obviously has led us to where we are today.
That's amazing. Now, what kind of plane did they put you in right off to start off with? Where did you begin, and have you stuck with the same plane all the way through, or have they put you in a lot of different jets, or what area do you kind of serve in with the Navy? Because I know they've got a lot of different stuff. Did you serve on a carrier? Were you different stations? Where, kind of tell me a little bit more about that.
Well, sure. I started flight school in Pensacola in I guess it was May of 2001, and then of course 9/11 happened right in the middle of that, which totally changed the game.
Right.
Everything got very serious, right? Everything got very real because we knew we knew we were all going to war at that point. I ended up I graduated flight school from in 2003. Ended up going to fly the P-3 Orion, which was a large submarine hunting aircraft and maritime patrol aircraft, and spent a lot of time in the East Asia area, out in China and Thailand, the Philippines, just bouncing around there, taking care of our interests, and making sure everybody was playing nice out there at the time. And I ended up doing that for about 3 years, and then ended up transferring down to the Gulf Coast here in Texas, and as a flight instructor for the Navy's primary flight school. And I was fortunate enough. They had a reserve unit attached to that unit. So when I got done off of active duty in '09, I was able to become a reservist, and literally start January of 2010 doing this on the weekends instead of full time. And so currently I'm flying the T6 Texan 2. It's the Navy's primary trainer. So we're it's training the next generation of naval aviators, Navy and Marine Corps aviators. And I got to tell you, they are the smartest, I think, group of young men and women that I've ever had the pleasure of teaching and dealing with. They say this group of folks in their mid-20s is lazy or whatever. I don't see it with these guys. They are all whip smart, and they're all showing up ready to play.
Well, I would say it takes a special breed to become an aviator to begin with. So you're probably seeing the best of. It's no longer millennials. Is this Gen Z or Gen Y? Where are we at with these guys you're training now? I'm not sure. I'm not sure which generation that is. It's one of them, but that is encouraging, because I feel like when you look at the future of the country, there's a lot to be nervous about. There's a lot to be kind of concerned, and you can point point a number of different directions and go, all right, this is an area of concern. What are we doing with inflation? What are we doing with government spending? What are we doing with the deficit and the debt and just the dysfunction that's coming out of Washington? But I think it's easy to get disheartened and look at these TikTok teens and all these trends. But I do believe that the loud, noisy news is out there. But when you really look at the country, when you really look at the backbone, there's a lot of great folks, and it's nice to know this future generation of pilots is doing good things. Now, I do have to ask. You said Top Gun was one of those kind of inspirational things. Now you're serving in this capacity. Is it the exact same, or was Maverick a little bit closer?
Well, I could tell you, I haven't played beach volleyball with my shirt off in quite some time. Let's put it that way.
Really? You stuck with the flag football instead. Got it.
Yeah, we do the beach football. Yeah, that's right. No, it's there's some truisms off of those movies. I actually really enjoyed the sequel. I think that actually spoke to a lot of things that I, as a guy who's only who's had a 22-year career on that side of the house, I related to a lot of those things. Part of it is also knowing when to kind of hang it up and quit, and I've already got that target date of August of 25 to hang it up, and I think it was a great story about knowing when to when there's a time and place for things and when to hang it up, and I've always said that I want to retire from that gig before it retires me. So I got a little bit left in me, but the end of that's coming soon.
Well, that I feel like is a beautiful segue into the financial side of things, which is where you've been working with Fairway since 2010, and you went kind of independent in 2016. Is that accurate?
That's right. Yeah, we were inside of an RIA.
So why don't you share a little bit about let's take a step back real quick and explain, for those of you that don't know, what an alternative is, because that can be a really broad space. I was actually at I was listening to some folks from Fidelity, and they were talking about alternatives, and after a minute, my eyebrow kind of went up. They were talking about annuities. And so when you think about alternatives, for a lot of folks, it's anything other than a stock or a bond, which is a really wide open space. So why don't you explain a little bit of alternatives and how you utilize them and what that means?
And it's I don't know if I would, with all respect to Fidelity, I don't know if I would lump annuities into alternatives, but
yeah, I was a little surprised when they said that.
but you kind of hit the heart of the matter. It really is any investment that's other than traditional stocks and bonds.
Okay.
Owning a rental house is a form of an alternative investment. Fine art and collectible cars can be a form of alternatives. The space we play in is typically more of a lot of the private credit sort of transactions. One of the things that, kind of dialing back a little bit on the history, you think about the global financial crisis in 2008. And, as a response to that, there was something like, I think there was something like 2,200 banks, both local and regional banks in the US, that basically either went out of business or were absorbed by, larger banks. Ended up shuttering local branches, closing local banks. And, it really created this huge vacuum in the entire lending industry because, the banks really, they shut the vault doors, and then they all got really big. So they said, well, small transactions just don't move the needle for us anymore. And, of course, nature abhors a vacuum. So, that left the private market to really start stepping into a lot of that activity that, banks traditionally used to do. So that was a big part of that. That's a big part of the alternatives that we manage now. But we also look at alternatives that can generate a cash yield, cash component to it. When we first started this whole business, a lot of the clients that we had, they were folks who were older, they were retirees, or near retirement. And, you think back to 2010, 2011, the zero interest rate environment kind of policy.
Right.
These are folks that they needed income, and traditional fixed income was just not going to do it for them at the time. Traditional fixed was about 2 to 3% was sort of the best that you could do with traditional fixed.
When you were going to get a mortgage, it's fantastic when you can get a mortgage at 2.5%. But when you're looking for income creation, safe, reduced risk income, and you're seeing the best I can get on bonds is 2-3%, that was a challenging environment. So how did this emerge as a space to help retirees? Because I know it can be incredibly aggressive, it can be conservative. So how did you kind of carve this out with Fairway?
Well, really, what we had started doing was sort of making individual one-off investments in three broad areas. The first was the private credit area that I mentioned. The bank-like activities, all with all the activity happening between two private organizations. Private lender, private borrower. The second area was really income, investments that were income producing hard assets. And these were usually assets that were out on the ground somewhere and they were generating a monthly lease, a monthly revenue stream. Although that being said, we avoid oil and gas type stuff. Despite being a Texas guy, I hate oil and gas investments. They're just too volatile. We don't.
I was going to say a lot of up and down. I know, not to date this podcast too closely, but everything that happened in Israel over the last couple of days, you see gas prices just skyrocket, and that up and down volatility. That's great if you're trying to make money, but when you're trying to have kind of that conservative growth, doesn't really seem to fit the same space. So I
can understand that.
Exactly. And then really the third area, Matt, was really what I like to call esoteric assets. And these were a lot of transactions that really a bank could never get their hands around. And these are things like the buying and selling of life settlements, which are, life insurance policies people have sold, sold on a third party market, or litigation finance, providing money to law firms that are pursuing, legal claims and legal actions. Really just stuff that generated a periodic cash flow, maybe not quite as cookie cutter as a loan where you're getting a monthly or quarterly interest payment, but they still generated a very predictable cash flow stream. And they tended to really kind of just live in their own universe, which was one of the aspects I liked about that asset class. So, really what we did was, we had started making some of these individual test investments. We said, gosh, we like each thing we're doing individually. For us and our clients, what would really be neat is if we could build a diversified portfolio of all of these things and build out something that, a wealthy family office group or maybe an institutional group like an endowment fund would build for themselves. And the idea being that, we could layer in all of these different assets and transactions, and they would, at the end of the day, generate a very steady return, generate, income, cash sources from multiple different sources. They would be very diversified. So, we would hopefully be ready for, whatever shocks to the system were going to come. And that was really the initial idea. And we launched that as a fund concept back in 2012. It was very popular with again, that for those folks who are at or near retirement, because we were able to give them a cash distribution, in the high single digits, sort of targeting that 7-8% in cash annually. And it worked out great. And, the added bonus that we didn't necessarily set out to think about it, but what we found was because the return, the whole profile of this portfolio tended to be very steady, low volatile, tend to be very steady returns. A lot of folks like to put it in their IRAs and just sort of say, well, hey, if you can give me, 6, 7, 8% annually, just, with minimal volatility, I'll just put that thing in, consider it an uncorrelated growth vehicle, uncorrelated to the stock market. Just let the thing grow at 7, 8%, and I'm happy with it.
Most people are not going to be savvy enough to know how these alternatives work and then be able to invest in a number of them. You might have one lending opportunity come up. You may have some company that does viatical life insurance settlements or something like that. But to be able to structure it and layer it across, that takes a degree of sophistication. And it also takes a lot of work and time. And so I know you spend a lot of time kind of looking into that. So looking at the future, real estate's changing. The environment is kind of shifting. Interest rates have had an impact on things. So when you look at the next 12 months, what do you find to be more attractive areas and opportunities of growth moving forward?
Well, you think about some of the big headline things that have happened this year. Silicon Valley Bank folded, First Republic, same thing, and a number of other banks, had a lot of troubled assets and issues, and they required some bailouts and some mergers. And the damage was not as severe as it was, again, from the crisis of 2008. The banks basically do the exact same playbook. You know, they're like a wagon train that just all immediately circles up the first time they see a shadow on the horizon, right? And that's what they did. You know, they closed the vaults, they stopped lending, they really tightened their underwriting standards. And you know that's been a boon for the private credit market, because what that has happened is you've had a lot of high quality borrowers who basically had to leave the banks and have come to the private credit market. And these are guys that, you know, they've got good collateral to put up. They can make interest payments. You know, they now have to sort of hold their nose and pay the higher rates that private credit demands, you know, compared to commercial banks.
Mm-hmm.
But you know, if they want to get business done, it's either that or just sit on their hands and do nothing, right?
Right.
So you know, the private credit market has been very strong, and I think it will continue to be strong. You know, I think the way banks are going, it's just going to continue to be a story of banks merging and the number of banks out there in the U.S., you know, declining, and you know, what happens when a bank gets really large, you know, the smaller transactions, like I mentioned, don't move the needle. You know, whereas a bank might have done a $10 million loan before, you know, they may now say, look, we're not going to do a loan under 50 million or under 75 million, just because, you know, we're such a large, you know, multi-billion dollar bank. You know, a $10 million loan, just, you know, the amount of expense that they have to do on underwriting and researching and everything, it's the same as for a $10 million loan as a $50 million loan, right? So, but again,
So
only one
from
of them moves the needle.
So for that cost benefit analysis, they're going, why would we do the 10 when we can do the 50 or the $150 million loan? That's what's going to generate more gain for the bank. Do you feel like this consolidation is a trend that we're going to see continuing indefinitely, or do you feel like there's going to be a vacuum and a demand for some of these smaller banks kind of popping up into the future, and then we're going to see new banks kind of fill that void? What are your thoughts, or will it be more of this kind of private placement, separate private lending? Or what do you see kind of moving into the future? I know I'm asking you to read the tea leaves on this just a little bit.
No, I mean it's a good question. You know, I was talking to one private credit manager who was in real estate lending not too long ago, and he made a comment to me that I thought was interesting. He said, you know, at some point when the banks continue to merge and you know there's less and less of them, at some point private credit just becomes credit. You know, that's where the majority of the borrowers, you know, business borrowers, real estate borrowers, et cetera, that's just where they end up going, because you know the traditional banks, you know, they'll continue to do mortgages, they'll continue to do very large construction loans, sort of things, very large project loans. But you know, it's going to be where a lot more borrowers, that's going to be their starting point, is the private credit market, rather than sort of where they end up. So I thought that was an interesting take on it. I can definitely see that. I think you see a lot more private credit offerings, you know, even I think infiltrating into our lives, right? You know, you see some of these lenders online that you can go to and get, you know, $5,000 to renovate your kitchen, right? You know, an unsecured loan. That's, you know, and that's all private credit stuff. That's not a, you know, that's not a major bank funding. That's not Bank of America or somebody. And I think we'll just continue to see that market grow and grow and grow. You know, another topic you brought up was the inflation piece.
Right.
And that's something that, you know, is on everybody's mind. You know, you see it when you go to the grocery store, and you know, now you realize the same amount of groceries that you used to buy is now, you know, twice as much as it used to cost, right? We're feeling it everywhere. I think at least one good news piece about inflation is I think it has slowed. It's not racing up as fast as it was at the start of the year. Now, the bad news is prices are where they are. We're not going to really see them go back, right?
Yeah, I don't think deflation is in our future. I think we might see, at best or worst, depending on your perspective as an economist, you might see some stagflation, right? I think we might see inflation slow, but the idea that we're going to go back to the price point of where it was 15 years ago or even 15 months ago is unreasonable. You know, some of the more volatile goods and services like gas, things of that nature, but I actually saw something kind of interesting. It was talking about it was a news article, and so I'm watching this, and I was reading the transcript of it, and I had to forward it on to a couple folks because I said, "You're not going to believe this." It was from 1982, and it was a reporter that was talking about the median home purchasing price in San Diego. Do you want to throw a guess out in 1982? Now, the article or this reporter was talking because prices had gotten so high. They said the average working class person could no longer afford a home in San Diego. You want to take a guess what the average home price was?
I bet it was probably $80,000.
It was about 85,000. Yep. And you think about that now, and you're like, if you could find property, just give me the dirt for 85,000 in San Diego, I would buy as much of it as I could get my hands on, no questions asked, right? And that's the power of inflation. You know, something that was untenable, now we look at it and go, that's an amazing price. So for those that are looking at it right now, I feel like when you see T-bills that are paying 5.5%, a lot of people look at that and go, well, why would I take any risk on an investment for 6, 7, 8? But I think inflation's going to come down, right? And when it does, those interest rates are going to change. So I know interest rate volatility has a factor on things, but what do you see kind of, I guess, where do you see inflation going over the next year, especially with the upcoming election?
Well, I think inflation is slowing. Obviously we had a huge jobs number that was posted for I think for September, which is good. I mean, I'm always a fan of the American economy doing well. I think the Fed may throw another rate rise here at us. I had thought that they were done the last time they did one, and then they threw one more surprise one at me. So we may see another little rate rise, but I think inflation, there's 2 points I kind of want to make. One, America has experienced worse periods of inflation. My dad all the time talks about, his mortgage that he had, in the 70s, which had like a 15% interest rate on it, right?
Oh, yeah.
Which even now, would be just unbelievable, right?
Jimmy Carter, great guy, didn't love his impact on mortgages.
So we're not as bad as we've been historically, right? And I think that the Fed has done an okay job getting it under control. A big part of this, I'm an economist by training, at least that's what my undergrad was, and also my focus on when I did my MBA. And I really can draw a straight line to all of the inflation we're seeing now from the effects of going through the pandemic, and 3 million workers in the US leaving the workforce for a variety of reasons related to that time. And it just takes time. It takes a whole generation to replace a 3 million worker deficit that happens all of a sudden. And I think that's what we're seeing. We're seeing more people getting into the workforce. We're seeing people coming off the sidelines, getting back in. We're seeing worker pay, rising. I think we will get back. We'll see supply chains are getting back to more normalized, schedules. I think we will see things normal out. It's just going to take some more time.
Yeah, I'm inclined to agree with you on that. I think when you look at the history of America, we've always had inflation. We have periods of high inflation, we have periods of low inflation, and I think we're going to get back towards that lower inflation. It's just a matter of time, right? We just kind of have to work our way through it. You can't shut down the world and any kind of business, trade, commerce for 18 months and not expect to have lingering effects, is the long and short of it, I think. Are you familiar with what happened with Christmas tree prices after 2008?
No, I'm not.
Do you know where I'm headed with this?
I have a fake Christmas tree. Then I think it still is actually up. I don't think I've taken it down since last week.
Perfect. Well, now you're getting into the festive spirit. That's okay. I can respect it. We'll do Christmas in July. It's a good thing. So here's what's interesting. After 2008, 2009, economy's not doing well. Folks are not doing well. Well, there was two things that happened simultaneously. One, we were going through a drought, and that was having an impact on things. So you have Christmas trees. You have more trees that are failing. They're not doing as well. Two, you had less people purchasing Christmas trees. So these Christmas tree farms had less operating capital to plant trees, pay for water these plants, move forward. So what happens is, go forward 10 years, because a Christmas tree grows about a foot a year. So if you got trees that were planted in 2012 and you want a 6 to an 8 foot tree, you go to 2020, that's where you're getting that tree that was planted back in 2012. Well, the price jumped significantly, and everyone said, why? And it's because there was less supply. Part of it was the drought, but a big part of it was they were planting less trees. They'd laid off some of their workers. They weren't able to tend to them the same way. And so when you're sitting there going to buy a Christmas tree, for my wife and I, when we're sitting here going to buy a Christmas tree, we're celebrating, we've been married for 5 years, and we're having our 5th Christmas together, and we're going, should we be buying a fake tree? It's going to be cheaper to get a fake tree than a real tree. It's because of something that happened 8 to 10, 12 years before. And I think we're going to see the same thing happen with COVID over and over again. It's like we're going to see things pop up and you're going, well, wait a minute, why is this hitting now? Well, it's a result of something from 5 years ago. You just didn't feel the impact yet. And so something that we preach to our clients all the time is around being diversified, having the appropriate amount of risk. And that said, I think stocks have their place in your portfolio. I think bonds have their place in your portfolio. Annuities, depending on the person, I think they can be a fantastic tool or not. But I think alternatives also have a space. Now, correct me if I'm wrong. I don't think it should be the only thing you have, right? You don't want a one-legged stool. So in your opinion, how much of your portfolio should alternatives comprise? And depending on whether we're talking to somebody who's 35 or 65, should that number kind of shift? Why don't we talk through that a little bit?
Sure. No, that's a great question. When I give presentations about what we do at Fairway and alternatives, one of the and I've done it with the Semmax clients as well, and hopefully they remember it. One of the things I like to do is I'll grab the portfolio makeup for the local college endowment fund. Because usually in pretty much everyone I looked at, whether it's the University of Texas's portfolio, whether it's some of the North Carolina colleges up there, every portfolio I've looked at, their allocation to alternatives is usually in the high 60% range, usually mid to high 60%, and that's almost every college endowment fund I've ever looked at. Now, college endowment funds and people have much different time frames and horizons, right?
Correct.
UNC is planning out for the next 100 years, right? University of Texas is planning out for the next 100 years, right? I probably don't have that much runway left in front of me. You never know. I moisturize and I eat my vegetables. You never know. It could be, but
hey, hydrate, get plenty of sleep, right?
that's all you can do. For individuals, we normally advise, about 20% is sort of the target range for individuals and alternative investments. And that's, that number, and that's why, advisors such as yourself get paid the big bucks, is to really look at a client's portfolio, look at their overall wealth and decide, well, how much liquid investments does this person need? Do they have some things they know are coming up on the horizon, like they're going to have to be paying for, a child going to college soon, or they know retirement's in the next 2 years and they want to buy that that dream house out in the country, right? That's where you have to sort of decide, all right, between liquid and illiquid types of assets, and that's something we should maybe highlight. As much as I love alternatives, one of their biggest drawback is that they're generally either illiquid or less than liquid types of assets.
So let's pause there for just one moment, because we have a pretty wide range of folks listening. Some have a very high investment knowledge, some don't as much. And they said, wait a minute ago you said hydrate, now you're talking about liquid. All right, wait a minute, did I miss something? What's connected here? So for those that don't know, or maybe need a refresher, liquidity has to do with how accessible those funds are, right? So if you have an account, if you've got money in your checking or savings account that's fully liquid, you can grab it immediately. If you have money in the stock market, well, you can sell those positions, you can create cash, it can be in your account within a week. The high side, let's say a week and a half. But when you move into other positions, like annuities, for example, they might have a surrender-free amount, but you can't take the whole thing in one go, generally speaking. Even something like a CD, a CD has a term. You want to hold it until that term matures. A lot of alternatives have that as well. So reduced liquidity is really just how quickly can I access those funds, or can I access all of it at one time, right? So with that said, how does liquidity impact these alternatives? I want you to pick up where you were going, but I want to throw that in just for those that may not be aware of what liquidity means.
Well, Matt, I always like to give, when I'm talking about alternatives, one of the things I like to give as a thought experiment, as an example, is, imagine you're buying a home that's going to be a rental home, right? A rental property, right? And you think about some of the things about that asset, right? And again, like we mentioned, that is a form of an alternative investment. I'm buying a property, I want to get a renter in there, right? You want a renter in there for probably ideally a year or more, right? Because you want him writing you, monthly rental checks. With that house, with that rental house, you probably don't care on a daily basis what that home is worth, right?
So you're not checking Zillow 3 times a week going, okay, is it worth 180 or is it 172.5 or that up and down?
You're not you're not paying for for an appraiser to come out every day of the week and give you a best price, right?
Correct.
You'd bankrupt yourself. So you don't really care on a day-to-day basis, what that asset really is worth. You may care on a quarterly or semi-annual or maybe even just an annual basis. Hey, what's this rental property worth if I had to sell it? Another thing that I highlight with that asset is, okay, if I did decide to sell that rental property, I'm not going to just say, I'm not going to go pick up the phone, call my realtor and say, I need this thing sold by the end of today. Whatever you can get, best offer, just sell it out and like get it done. You're not going to do that, right? You would do an orderly sales process. You put the sign up, you make sure it's all nice and tidy, get a couple of different bids, et cetera. It may be on the market for a couple of weeks, et cetera. But you're not, even if you did have the ability to sell it that day, you probably wouldn't, because you wouldn't get the best price out of it, right? You wouldn't maximize your value, right?
You give it a little time for those final and best offers, and then you accept you're not going to get it until closing 45 days from now, right?
Exactly. Yeah. So that's when we think about illiquidity, that's the sort of methodology I like to kind of talk around, because, yes, there's some illiquidity with these assets, but it's for a thoughtful reason, right? I don't want to fire sale assets and lose the value that has been building up in them. And, by the way, I've gone around and around on this topic with other professionals, and I've had a lot of people make the case that, when the stock market goes down 20%, are you really going to sell at the bottom of that drop, right? Well, no, because the market's going to recover and come back up. So really, how liquid were you then with your stock market holdings? Sure, you could sell them at the bottom of that 20%, but you don't want to crystallize those losses, right? You'd wait. So I would argue that illiquidity, there's a whole spectrum of it, and I think it does apply to both to traditional investments and alternative investments.
And I think along with that 20%, something that I think through when we're talking about liquidity is, let's just use that 20% example for just easy numbers. Let's just say you have $2 million. Well, that means that's about $400,000 that could be allocated towards this alternative. That means you still have about $1.6 million that's in something else, whether that's stocks, bonds, etc., REITs. And I want your thoughts on REITs here in a moment too. I'm going to come back to that. So what that means is, yes, you've got that 400 that's a little bit less liquid, but we still have full liquidity on another 1.6 million. And what I ask folks is usually the question of, when is something going to happen where you need more than 1.6 million at one time? Right? Now that's for somebody who has 2 million, but it kind of begs the question, is like, well, do we really need to access every dollar that's over here? And then also we got to think about tax ramifications. I love the fact that you brought up the fact that it's in IRAs, because, in most cases, it's in IRAs. And the reason for that being, I'm probably not going to reach straight into your IRA account and pull $200,000-$300,000 in one go. We really don't want that to hit your tax return all at one time, right? So, I agree with you that I think liquidity, it is important to know when you go into something, how can I get out of something, and how is it working? But I would agree, when you hold fast to that appropriate percentages, it's less of a concern. So I want to ask you your thoughts on REITs as well, because I know some folks kind of go, okay, I can just get this basic REIT, I'll throw my money in there, and then I'll take it out whenever I want. What's your opinion on REITs and kind of the space that they occupy? And do you mind just giving a brief example of what a REIT is? Because, again, some folks may not know.
Sure. Well, a REIT stands for Real Estate Investment Trust, and we have a few that we've invested into in our various fund entities at Fairway. So I guess that shows you that I do approve of them. And one thing that came out of some of the tax law changes of the prior administration was there was a more favorable tax treatment of REITs. I think it's you'll have to refresh me, but I think it's the first 20% of income is not taxed off of a REIT, and there's also a UBTI blocker in there, which is an important thing for IRAs. So it's a great structure. I really like the structure. There's a couple downsides to the REIT structure. One is they have to basically distribute all of the income out of the REIT, which can be a little bit of a challenge sometimes. It may mean that investment isn't necessarily recycling that income and adding to the investment and making that investment grow larger, because they're having to distribute out cash, which may be a slight downside to that. But for a lot of folks who know real estate and understand it, and just want some sort of coupon, it's a great way to go. What kind of going back to the earlier discussion point about, what happens if I invest in one alternative investment versus if I invest into a portfolio of alternatives? What happens when that REIT gets into trouble? What happens if if there's a lot of office space in downtown San Francisco and nobody's going, everybody's working remote and doesn't want to go back there. And so now the occupancy rates, get slashed, and the rental rate, the leasing rates, go down the toilet, right? That's part of the reason that we have built a diversified portfolio for folks to allocate to. Because again, going back to your example with the guy with $2 million and 20% of his allocation, 400K, imagine if you put 400K into one REIT versus 400K into a diversified portfolio. And, even if that included the REIT inside of it, if that one REIT fails or, goes through trouble, that's all of your alternative allocation versus the diversified portfolio, which it's just a piece, maybe 5% or less of that portfolio.
Mm-hmm. Yeah, I really like that. And I think what you touched on just a second ago was really key for folks that maybe missed what you were saying as far as how it has to distribute all the income. Because you have a lot of folks, or at least I know I have a lot of clients that I work with that say, I love this fund, I love what it's doing. Don't take the money out, just reinvest it, keep going. Keep it going. You see that a lot with dividend-paying stocks. Some folks want to pull those dividends off. They want to live off the income. But a lot of people say, don't, just reinvest those dividends. When the market's down, now I'm buying more shares on sale. When the market comes back, I've got more shares growing as well. And so I think that REITs, to your point, they can serve a place. They have a space in the investment world. But I don't think they're the silver bullet that everyone should invest the same way and everyone should just put everything into a REIT. I think there's a little bit more nuance to it for sure. Looking at kind of where we stand right now. So we've touched on inflation. We've touched a little bit on where interest rates are headed, and I agree with you. I think we're going to see them level off, and then ideally maybe drop just a little bit. Probably not dropping back to the levels they were at 2015, 2016. But I could definitely see them softening a little bit. In your opinion, because I know I've got an opinion on this, but I'd love to hear yours. We're already talking about the next election. We're already talking about this election cycle, and what if it goes one way versus another? In your opinion, as an economist, what impact do you feel like that's really going to have, if any? And if so, how long is it going to take for it to start to manifest?
Well, it's hard to tell, and I'm not in the business of predicting elections. I'm not going to even try.
Well, I think we're way too far out to even know for sure who's running.
Exactly. Yeah. There's a lot of X factors ahead of us. But really, if you think about, I think about some of the signature policies that have been put into place during this current administration. Policies that are meant to spur microchip design and development and production here in the U.S. Policies that are meant to build infrastructure projects. And, you think about it, from the day that those policies get passed through Congress and signed on the president's desk to the point where, say, on the infrastructure bill, the point where a shovel breaks dirt and starts, building a bridge or a highway or something, that's a multi-year period. That's a long time, right? And, the impact of any of those sorts of policies, it's something that I think you have to look back 10 years after that sort of legislation gets signed before you really can conclusively point back and be like, oh yeah, they did build that bridge that we really needed. Oh yeah, it really did help out. Now businesses were able to grow on that side, the other side of town. That's how long that sort of cycle plays out. So, I know there's, we get inundated with the news and this, that, and the other, and it's easy to get kind of, lost in the chop of all that. But, when you look at the major actions, they just take, on the order of 5, 10, 15, 20 years sometimes to really be felt.
So it really does take time to feel the impacts of things. And I agree with you. There's a lovely chart. If I remember, I'll attach it in the show notes. But there's a chart that you can see where when you look at the stock market's an easy indicator of this. If you look at the 100 days prior to and 100 days after a presidential election, whatever that trend line was, you really see it continuing. Now you might see a momentary drop, or if it's going down, you might see a momentary spike. But really, whatever that trend is, you see that continuation both ways. And I think to your point, and that's what I thought you were going to say. And I'm glad we're on the same page there, because I think we get so caught up in the 24-hour news cycle and what happened today and what happened in the last 10 minutes, we lose sight of what's the long track of how we're doing. Really, if you look at the last 10 years, look at the last 20 years of our country, have there been some things I love and dislike from a social standpoint or from a political standpoint? Absolutely. But when you really look at the country as a whole, where are we headed and kind of how are we shaping? Now, I've said this before, and I'd love to get your take on it. But in my opinion, I think there's two kinds of economists. There's pure economists, which look at things and approach it from the framework of, if you pull this lever, this bell is going to ding. Now, they don't tell you necessarily whether or not you want to ring that bell. They're just saying, if you pull that lever, that bell is going to ring. But at the same time, you're also going to ring this bell over here that you maybe didn't intend to. They're not looking at it from a policy standpoint. They're just looking at it from an input-output. And then you also have, and again, I'd love your thoughts on this, I feel you have more policymakers where they're trying to ring a certain bell. So they're pulling levers with the idea of trying to ring a certain bell, and they're not necessarily looking at it from all of the collateral damage. And so it's like you might have what you want, but unintended side effects. And I'll give an example of this. If you look at seatbelt laws, it's very clear, there's a very clear correlation that wearing a seatbelt reduces fatalities in car accidents. This is not debatable. That's just a fact. However, when you look at the introduction of seatbelt laws requiring people to wear seatbelts, did the number of fatalities go down? Well, you would think no, but in actuality, there was no change. Like, you would think for sure, if everyone's required to wear a seatbelt, and if you're in a car accident and you wear a seatbelt, you're going to have less fatalities. But that doesn't account for human nature. And human nature says, well, I'm wearing this seatbelt. All of a sudden, I can drive more recklessly because I feel more comfortable. I'm not going to die. So what happens is the number of accidents goes up. The number of people suffering non-life-threatening injuries goes up. Insurance rates goes up. Damages go up. And the number of folks dying actually remains pretty much flat. And so that's where it's like and I'm not saying not to wear your seatbelt. That's not the takeaway from this. But the idea here is, right? But the idea here is that the law was passed because we want to save lives. Well, did you actually save any more lives, and what was the unintended cost, right? And so looking at that, I look at a lot of the politicians, and they seem more like policymakers than pure economists. And I think that's where the disconnect comes into play, where you're trying to ring one bell with no regard to what else is getting hit. I don't know if you got some thoughts around that or not, but it's been something that's been on my brain for a while now.
Well, it's always hard to predict what the unintended consequences are, right? That's why they're called unintended consequences, right?
Correct.
We pass a law that says we want more microchips built in the U.S., and now all of a sudden our trade with China goes down, and because it goes down, they decide to stop buying, the almonds that our farmers in West Texas produce, right? Unintended consequences that we don't know about, right? What I do think about often, actually, is I think about how adaptable both, we as people and our economy both are. And I'll give you an example of that. One of the investments that we've got in the Semmax fund and all our other vehicles that we operate has to deal with home equity contracts, which are basically a sleeve of a portion of somebody's home that they own the equity in, and a portion of it is bought by an investment group at a discount. And then when the home sells, there's some appreciation on and realization of that discount. It's a very interesting option aside from like a home equity line of credit or a reverse mortgage, which I'm really not in favor of. So it's a cool option in there. when we were speaking with that group, that management group, we said, okay, well, obviously mortgage rates have risen significantly. So how does that impact your ability to realize these options? Because you're the way you get out of them is somebody either sells their home or they refi their home. And they said, well, what we saw at the kind of around March of this year when those rates really shot up, we saw that home selling activity, it sort of dropped, it sort of came to a dead halt, right? Because rates were just spiraling up, rapidly. And they said, but here's our chart from July and August, and all of a sudden, home selling activity has kind of gotten back to normal rates that we're used to seeing about this time of year. And it wasn't because interest rates had gone back to where they were at the start of the year. It really was just because home buyers had just sort of adapted to the new norm. And the way they adapted to it is they said, okay, well, look, if I've got to have a mortgage that's at 6-7%, well, then that means what I'm willing to pay for this home is going to go down, because what's really important to that person is, can I make a monthly mortgage payment, right? And they aren't really thinking what percentage of that is principal, what percentage of that is interest. They're just thinking, can I fit this in my budget? And if they can, the answer is yes. They'll buy it with that 6, 7, 8% mortgage, and hopefully refi down the road if rates go down. So that's what I think happens a lot is we get change in the system, unintended consequences, intended consequences, and we adapt to them, right? We're resilient, and our economy is resilient, we as people are resilient, and that's just what happens. We adapt to the new norm.
I think you hit the nail on the head there, because that resiliency is something that I think gets forgotten on times of ease and convenience, but we all have the ability to, if necessary, we could probably trim a little fat from our budget, right? We could probably cut in a number of areas, and then even when it comes to kind of what we're eating, we could probably all trim a little bit from our diet as well, and we just kind of adapt to where things stand right now. I can tell you, as a longtime Carolina Panthers fan, back in 2015, 2016, you got Cam Newton launching the ball, out of the stadium. At the same time, Luke Kuechly's taking the opposing quarterback's head off. I hope you're not a Tony Romo fan, because I think Kuechly ended his career when he broke his arm. But you go back into 2015, 2016, it was fun to watch the Panthers. They were winning every week. And actually, I don't know if this tells you something about me, but I was talking to my wife, and she was like, "Are you excited about the game?" And I was like, "I'm honestly not that excited." And she said, "Why?" And I was like, "Because I already know what the outcome's going to be. I already know we're going to win. It's just a question of what's that final score going to be." You're like, "I don't even need to bother watching that. There's no thrill in the chase." Well, I kind of feel the same way now, but it's not because I'm confident we're going to win. You look at, we're now 4 or 5 weeks into the season. We've yet to win a game, and there's some glimmers of hope, but we're in a rebuilding decade. It's starting to feel like last year was a rebuilding year. Year before that was a rebuilding year. At the same time, those happy times of watching them win every week have been long gone. But you still enjoy, and you just appreciate where you are, and you just accept what's going on. You just kind of get through it. Now, are you a Texas A&M fan? Are you a Longhorns fan? Do you have a football team?
I am a Longhorn fan, as you might expect. I'm a little disappointed we didn't win the Red River rivalry this last weekend, but we've been doing so well this year, and hook 'em horns, and hopefully we get them.
Yeah, and that's the beautiful thing about football, is you just kind of accept we can't win every game, but are we playing well? Are we having a good season? It gets tough when it's hard, but you don't all of a sudden quit being a fan. If y'all have a record where you lose 6 games this season, you won't exactly be happy about it, but I don't think you're going to have a bonfire and you burn all your Longhorns gear, right? It's a little bit of the same thing in the market. When the market's down, when we're in kind of the doldrums, if you will, you don't go out and just light your investment portfolio on fire, move it all to cash, throw it all away. We're done with everything. That's why you have that diversified approach. That's why you have these alternatives, and that's why I appreciate you taking some time to talk to us about these alternatives. Let me get your thoughts on gold, because I know a lot of people go, "Hey, gold's never been worthless." And I'm seeing a lot of commercials about gold. What's your take on gold right now?
I read an article this morning that actually said a better return on investment Legos that were kept in the unopened box and held over time. That apparently that those unopened boxes of Legos and kits were worth more than gold. They were a better investment than gold.
Oh, where were you when I was 8? I was sitting on a gold mine there.
Yeah. I don't know. Yeah, I don't know anybody who's got unopened Legos, but I don't know. I think there's a lot of people who enjoy, they enjoy buying gold, they enjoy collecting it, and there's certainly a satisfaction, I think, to having a physical object in your hand that you can say, I know this has some value. But again, there's a lot of problems with gold, right? If you're buying physical gold, you've got a portability problem, right? I mean, I knew a guy who, he had 2 safes worth of gold up in his attic, and I was afraid that his attic was going to collapse in under the weight of, these 2 giant safes.
He's got to reinforce that subfloor before he can keep buying.
Yeah, you should have put this on the ground level, but so there's a portability issue with it, obviously. Right. And it's, at the end of the day, do you really want to have physical gold like stashed in your house somewhere, or a safe deposit box? And then there's the certificate way of buying gold, where you're buying these gold certificates. And my concern about that is like, all right, if I really pull on that certificate, at the end of it, will I actually find a brick of, a bar of gold, or some gold coins or somewhere, so
and there's fees. There's fees with issues with those certificates as well. It's like they charge you to get in a commission, they charge you to get out, then they charge you a management fee along the way, and you never even receive that physical object. That always irks me, is when you get nickel and dime. But I'm sorry, you were in the middle of something. I thought about that.
I think it comes down to just, sort of back to philosophically, I don't like single asset sort of investments, right?
Right.
They can be problematic, just like I don't like buying single stock names. You can, all of my stock investments are basically in mutual fund type of investments, because you can ask all the people who had Enron stock, as their retirement portfolio, you can ask them how that story ended up, right? So look, I think it's one of those things. If you like gold, if it gives you some satisfaction to have it there at your house and you're safe, then by all means buy it. But certainly don't make that 20% of your portfolio.
Right. And I've actually been saying for a while, when it comes to gold, especially when you're seeing, because I've noticed I have more clients asking me about gold when you're seeing all these commercials saying you should buy gold, and they go, okay, I should probably buy gold. Well, here's the biggest problem I have with that. A lot of these commercials are saying gold has never been worthless. Gold has never lost all of its value, and you should buy our gold because the U.S. currency is on shaky ground and who knows where things are headed. And I think about it for just a moment, and I just kind of go, and you tell me if you're in the same mindset or not, but I think about it and I just go, wait a minute. You're telling me you have an asset that has never been worthless and is going to appreciate and is only going to be worth more in the future. And in exchange, you have this cash, which who knows what's going to happen, and that's going to lose all its value. Now let me trade you my asset for that cash, which is about to be worthless. That's what that commercial's telling you. And people kind of pause and go, wait a minute, I think you might be onto something here. My opinion, I think the best time to buy gold is when you see all the commercials saying we buy gold. Trade us your old silver, trade us your old gold. When they're trying to sell it, that's the time to be selling, in my opinion. If you're going to try and time the commodities market like that. But I don't know. I'm with you. I think having too much of any one thing is not great. If I'm going to invest in one metal, and it's going to be, I would actually do it in 2. I wouldn't keep it all in gold. Personally, I prefer lead encapsulated in brass, usually with some kind of gunpowder behind it. I think 9mm rounds and 223's never been worthless. Tell me if I'm wrong here.
Well, I think there's a time and a place for every asset class, and absolutely. And, if I had anything to say, it's I wouldn't go all in on that sort of asset class either.
Yeah, I think moderation. But if we are going post-apocalyptic world here, and we're going to a barter-based system, I think instead of shaving off a few ounces of gold, if I came to you and I said, hey, I got 14 12-gauge shells, what can I get for it? I feel like we could work out more of a deal. But that is not, I by no means am I recommending that you take your entire retirement plan, take everything out and buy ammo with it. That is not the takeaway from this.
What
Well, I will say, Matt, one thing I really love about the American economy is that, we have managed to make it through pretty much every crisis that I've had in my lifetime. We've managed to make it through every crisis we've had in the last 100+ years, and those include world wars, those include global pandemics, those include inflation, those include stagflation, those include Great Depressions. And, we're still here. And
absolutely.
I have a lot of faith in America. I have a lot of faith in the American economy. Uh, the vast majority, 90% of our portfolio plus is in American assets. And I think you just can't find a better place to invest. We're just so resilient. We're so broadly diversified geographically, and we're such a nation rich in resources. I just think you can't find a better place.
I agree with you because we don't have to go down the line, but if you just started listing off countries and compared their economies, compared their resources, compared the growth opportunity, and just kind of said, where would you rather have your money invested? You could take all day. We could just go through a map and start picking it off, and I think you're going to find the U.S. just consistently beating out. And so that's not to say you never have anything in overseas or emerging markets or anything like that, but I agree with you. I feel like it's really easy to focus on the negatives, but there's a lot of positives to being in America. There's a lot of positives that we are blessed with the country that we're in. And then from an investment standpoint, I think things are more robust than we necessarily feel because we do have a tendency to focus on the negatives. Let me ask you this. Being a longtime military guy, also being in the investments and being an economist, do you find that there's any kind of skills and maybe not necessarily a hard skill, but also just like a soft skill that applies in both? Are there things you've taken from your one career that carries over into the other?
I was thinking about that the other day, and I was thinking every time I put on my flight suit and I put on my survival vest and the G suit and I hop into the plane and I buckle everything in and all that, you know, that's not my airplane. That belongs to the people of the United States, the hardworking taxpayers who made
Mm-hmm.
not only my survival equipment possible, but made, me being able to fly and train a young student possible and made that aircraft possible. And, I have a duty when I have that resource, I have a duty to take care of it and to make sure that I bring it back in one piece, as good as I found it. So it's ready for the next event with the next student and the next instructor. And I've always kept that thought through my entire Navy career was any of those assets. I've got to be a good shepherd of these things because the nation has entrusted them to me to manage and to do right by them, and to help improve our security and safety in the U.S. And I think about that on the investment side. When an investor brings their capital to me to deploy,
Mm-hmm.
that is their hard-earned money that they have made over the lifetime of their career, and money that their family has saved and built and put together. And it's my responsibility to take that capital and work, put it to work wisely, and also to be a good shepherd and good steward of it, and return it back to them, hopefully larger than they gave it to me. So to that end, I guess that's a way of saying I take that responsibility seriously. I take that that trust. I feel that trust and confidence that has been put into me both on the military side and on the financial side. I take that very seriously because that's a very, it's almost sort of a sacred bond that of trust that someone has given you. And I think that's something that it's something that I think about every day when I look at both our portfolio and what I can do for all of the investors.
I think that's a beautiful thought, and it's so true. I think there's a biblical precedent there as well. It's like you're supposed to be a good steward of what you've been blessed with, or what you've been entrusted with. I know a lot of times we think about that on a personal level, saying, okay, what do I have personally as my own assets? But really, it applies to what am I stewarding or shepherding for others, and I think that's fantastic. And I appreciate that you don't think of it as this is my plane. You think of it as America's plane, and you get the opportunity to operate it and educate and distill some of that knowledge that you have and just pour it into the younger generation. That's incredible. Now, I know education is a passion of yours as far as educating investors and making sure folks are very knowledgeable. And so is there any kind of overlap between these young pilots and investors as well? Or are they pretty different from a mindset standpoint?
Well, none of my investors try and kill me on a daily basis, so that's at least one big difference
That's a
between them and the
positive.
flight students.
Yeah.
Real big difference. No, but in all seriousness, I think what it comes down to is it does come down to communication, and it does come down to
Right.
education. And one of the things I think another skill that came out of my career there is, we would frequently do, aircraft commander boards where, the senior instructors would all get in the room and they would hit you with the tough questions and tough scenarios. And, you had to be knowledgeable and ready and responsive to those questions and scenarios. And to that end, I am never afraid to take the tough questions from, advisors such as yourself or from investors, and I welcome it. I want you to bring the tough questions to me because I should have a good answer for them. And if I don't have an answer on the spot, I will find it out for you post haste and get it back to you. I think that's a big thing that I like to emphasize to people, and I feel sometimes it's maybe a little underutilized. We're always happy to pop the hood, let you kick the tires.
Yeah.
We're always happy to take the tough questions. That's what we're here for.
Well, I know, especially when we, on the front end, when you and I were really starting to get to know each other and start to work together, I'd hit you with the most off the wall questions. I think sometimes you might look at me and went, why are you even, that is not even remotely related to what we were talking about. But sometimes I did it, I don't know if you knew this, but sometimes I did it because it was just a random question that popped into my head out of curiosity. And sometimes because I wanted to see how you'd respond. It's like, okay, that's off the wall. Are you going off of a script, or do you really know what you're talking about, where you can hit something completely unrelated and come back to it? And I was always impressed with the knowledge that you had of how this fund operates, how the investments work. And it wasn't some canned thing from a representative standpoint. You really understand the mechanics of what's going on, and you can speak to it from a very deep level. And that's something that I think our clients really appreciate and value. I would say that's something that I think there's a fine line there, because you get a lot of folks that go, well, wait a minute, you're the advisor or you're the fund manager, you handle it. That's what I have you for. I don't want to know this stuff. But I do think there's value in understanding how these mechanics work, understanding why we're doing what we're doing, because I think the why is what really ties it all together. If you just understand what we're doing and how we're doing it, but the why is not connected, that's a crucial component. And I think that's key. Again, whether you're flying a plane or whether you're investing your funds, and it could be as simple as talking through Roth conversions, or why are we using these tax dollars instead of those tax dollars? What the heck is a K1, and how does that affect my tax return next year or 2 years from now? And so I think when you're able to connect the why behind it, and you're able to share that passion and that engagement, and that you care why it is the way it is, that makes a big difference, and it comes across. Well, I've really enjoyed this conversation. We could probably talk finances all day, but I won't keep you for much longer. But I do have one final question. I want you to imagine you're trapped on a deserted island, unlimited batteries, let's say it's solar powered, but you can only bring one album. What are you listening to? What's it going to be?
One album, gosh.
Yeah.
I'm a big fan of Queen Freddie Mercury. I would take
Okay.
his best of, especially his some of his live and concert type of stuff.
I just wonder, 3 months in, you're listening to Another One Bites the Dust, and you go, I don't know how I feel about that.
That's when I might just turn off the stereo and enjoy the view.
There you go. You go, you know what? We're going to listen to the waves for a few minutes now. No, that's fantastic. I did not know you're a Queen fan. That is awesome. That is awesome. Well, that's the last question I had for you. So I really appreciate the time. Thank you so much. If you're interested in learning more about Fairway, about the different funds that Jason manages, about alternatives in general, please don't hesitate to give our office a call. We can absolutely get you connected. Whether you've been working with Semmax for a long time, or if this is the first time you've ever heard of us and you said, hey, you brought up some interesting stuff, I'd love to learn more, you can absolutely get connected to us. We'll have some stuff linked in the show notes. But Jason, thank you so much for your time, for your expertise, and we value you greatly. So we really appreciate it.
Well, thank you, Matt. It's an honor to serve the people at Semmax, and it's an honor to be able to be here today. I really appreciate it.
Well, we look forward to many years together. You're retiring from the Navy, but you're not allowed to retire from this bed. You got a little ways to go, right?
That's right. Yeah.
Awesome. Well, thank you so much. And thanks, folks, for listening. I hope you've enjoyed this. And as always, don't just listen to it, but I hope you take something from this and are able to put it into practice. So have a wonderful day, and thanks for listening.